Hi trader, welcome to Elite Currency. This video is on moving averages. In our opinion, moving averages are very important for trading, and you will find out why in this video. Let's take a look at the charts and discuss the moving averages. So you can see here we have multiple moving averages. Now you don't have to, of course, necessarily use different layers of moving averages. Some traders do perfectly well with just one, and of course some even without them. But I'm going to explain why we think moving averages are a key part of trading and analyzing. The number one reason is that it shows the market psychology. Sure, the trend, of course, we can spot the intermediate momentum, and of course even the short-term kind of power that we see in the price action we can measure with the moving averages. Those are all logical reasons why moving averages are valid. They also work very well as a support or resistance zone as well. So very key points. But ultimately, it boils down to the market psychology, because by using price action in combination with moving averages and comparing moving averages to moving averages, we can understand the angle, the direction, the speed, whether there's any divergence occurring, and also whether price is at an important key decision zone. So we understand not only what's actually going on, but even one layer deeper, the psychology of the market. We can see, for instance, whether price is pulling away from the moving averages and whether the moving averages are being pulled away from each other. This gives us vital information about the market structure and whether price is indeed trending slash showing momentum in a bullish way, bearish way, and with what kind of strength. So those are a lot of criteria to look at, and it's not easy to train yourself to kind of mentally and visually keep an eye on all those things. So that's why, of course, it's good to have a system for yourself that makes it simpler. For instance, our SWOT system tries to simplify all those aspects into a coherent trading system. But you too could choose, of course, different ways of using moving averages. That depends from trader to trader. My point of this video is to explain why really ultimately, especially the Forex market, how much price evolves and basically uses those moving averages as it pulls away and pulls back to them. So we talked about moving away, but we didn't talk about the pulling back period as well. You can see how price basically makes a retracement back to these moving averages, back to these moving averages, back to these moving averages here, as you can see, and then those are used as a bouncing platform. So it's this pull and tug as price moves away and back to the moving averages that is constant and is continuously happening on all time frames in the Forex market and other financial instruments too, but I think most of all in the Forex market. And you can see by having multiple layers, like this for instance, on you can see here, for instance, on the 4-hour chart, this is the pound USD, how we have basically a long-term, a medium, and a short-term, right? So we have long-term, as you can see here, medium-term. So if the medium is above the long-term, you can see how even though prices may be retracing back to them, right, goes back, that ultimately still uses the long-term moving average as a bouncing platform for an uptrend continuation. So as long as basically intermediate is above long-term, price might make a deep retracement back, right, and there's some good trading towards those levels, but ultimately keep in mind that the trend is up. And also, once the short term is up, you see this 21 EMA band here is above those moving averages. That's really where we have the best zones and the best breakout trades as well. As you can see, those have the most potential. So this is valid for all time frames, more or less, and all currency pairs and many financial instruments. You can see how when everything is aligned, it is very valuable. And this is not even the short term, this is kind of the ultra short term moving average that indicates is momentum now up, or is it down, or is price just going sideways, right? It shows us the strength of the momentum. So this is long, medium, short, and let's say ultra short in a way. And it is so valid, it's valid for all time frames. You can see this time and over again, you can see how price, as it goes into this long-term zone, uses it as a bouncing spot. Here you can see how price crosses over those both too. And this is on all time frames here, euro dollar. You can see as well how price basically neatly moves away from the zone. This was a consolidation, but price breaks above it and then uses the zone twice to bounce basically. And what I mean zone is this blue zone here, right? The difference between the intermediate and the long-term moving averages. How that zone increases in space and in thickness in a way as price moves away from it. And as price goes back to it, uses it as a bouncing spot for upside continuation. So this zone, great for bounces. And of course, we can see how when price gets back into above the 21 EMA here, above the short-term moving average, how it also is good for breakout potential, especially if the ultra short-term moving average is aligned with our upside. So that's just a quick note about how you can use moving averages. I mean, we love this quadruple style because you have you see where basically the long-term support zone is or resistance. That's between the intermediate and medium moving average. You see if the short-term moving averages are above the long-term ones and bullishly angled, then good for breakouts. And if the ultra short one is on your side, that means that momentum is on your side too. Look at this, for instance, right here, right? Turns bullish, turns bullish. That's exactly where the momentum kicks in the market. Plus, we get our confirmation from our multiple time frame indicator at the bottom, and that also shows perfectly when larger time frames are aligned or not. So to wrap it up, once again, the moving averages are especially important because of the market psychology. Thanks for joining us, and please, of course, share, like, and subscribe, and wish you all great trading. Cheers.